We've given up trusting the banks. We've given up trusting who were supposed to be the fiduciaries, and we can take control back ourselves.
Michael Burry has come out and said very openly that the mother of all crashes is coming. Cryptocurrency is going to crash.
It's going to be the largest distribution or redistribution of wealth in all history.
What's up, everybody? I am Jaspreet Singh from theminoritymindset.com, and today I'm sitting down with the cryptocurrency expert Raoul Pal, and we're going to be talking about all things crypto and what's coming in cryptocurrency. Raoul Pal used to be a very successful hedge fund manager, and then he retired when he was just 36 because he wanted to dive fully into cryptocurrency, and he moved all of his money into crypto. Not only is Raoul Pal fully invested in cryptocurrency, he also runs RealVision Crypto, which is a video channel which is helping its more than 100,000 members understand cryptocurrency and understand this massive transfer of wealth that's happening because of cryptocurrency. They're publishing like 5 videos a week to bring on some of the smartest minds in finance, and it's completely free. So if you want to learn more, you can check it out, realvision.com/revolution, and I'll also link to it in the description below. So let's jump into the interview. Raoul, thank you for being on with us at Minority Mindset.
I'm super pleased to be here. Thank you for inviting me.
So I want to dive right in. Why should people care about cryptocurrency now, and how is cryptocurrency going to change the world?
You don't start with a small question, do you?
No, we go right in.
Why should they care? This is the fastest level of adoption of any technology in all recorded history. So the internet grew from 1990 to 2000 at 63% a year. In 1997, there was 150 million users of the internet. Currently, there's 150 million users of crypto, and the network is growing at 113% a year. So it's twice the speed of the internet. So what does that mean? This is the network of money, the network of value. Now, if you understand network businesses, you'll understand Facebook. So here's a giant network, 3.5 billion, where we got to use the network to connect with people. Unless it was yesterday when the internet didn't work, when it all went down. But let's assume that it did work. You get to get the psychological benefit of likes and connecting with people, and they get to monetize you. So the value of the network accrues to the company and the shareholders. So the shareholders got rich, and our brains just rotted. That was the trade-off. But when you're talking about cryptocurrencies, it changes that network model to something where the network participants are also the owners of the network. So the network, let's say at the simplest level, is Bitcoin, and everybody who uses the Bitcoin network has to use Bitcoin, has to own Bitcoin. And so the more people that come on the network, the more the value of the network goes up. It's called Metcalfe's law. It's the value, the number of connections, plus the interconnectedness between all of the people on the network. So crypto supercharges this, which is why it's growing so fast. It's kind of built in human behavioral virality within it. So what does that mean, and why should people care? Well, we've already said it's the fastest adoption of any technology in all recorded history. If you'd have known about the internet in 1997 and had made the right bets, which was harder back then because it was multiple companies and not the underlying protocols. Here we get to bet on the protocol. It's going to be the largest distribution or redistribution of wealth in all history. So why do I say that? Well, we can just extrapolate the numbers. As networks grow, the rate of growth comes down a bit. So it's currently growing 113% a year. If it drops to 83% a year, then we get to 1 billion users from the 150 today by 2024. We get to 3.5 to 4 billion users by assuming the trend rate of growth then drops after 5 years to, let's say, 63%, which is the internet grew at. We get to 4 billion users by the end of the decade. So if this is a network of money, therefore the value of this network is going to utterly explode. So how do I put that in context? In context, it means that it's currently a $2 trillion market. Sounds big, right? But all the other asset classes, like equities and bonds and real estate, they're all 200 to 300 trillion. So if this is going to grow at the speed we think and get the adoption that it looks like it's getting, and that's provable maths, then the probability is that this gets to be worth 200 trillion at least.
So you think that Bitcoin, Ethereum, these have the opportunity or ability to 100x in the near future?
The entire space, not just one coin. Everything you touch, basically. Now, there's going to be winners and losers. So that's the financial incentive of why this matters. But it matters at a much deeper level, which is this is a redistribution of power within the financial world where the individual doesn't need the middleman. So this is the transfer and storage, trusted storage of all digital assets, and eventually all assets go onto a blockchain. So this is the start of new business models, and everybody watching this will have seen the rise of NFTs, which is a nascent start in what's going on here. We'll see the rise of social tokens. All of these things are blockchain enabled. We're already seeing finance itself be decentralized finance, where there's no bank. It's an algorithm, and it's based around these blockchain protocols. And the smart contracts allow these protocols to be programmed. So that means you can put a set of rules in it. So it's going to give us the power not only to invest and make money, and these things, Bitcoin may be 50,000 today, but it breaks down to 8 decimal places. So anybody can put 10% of their net worth in, however poor they are. So for dollar cost averaging and wealth building, this is extraordinary. But it also creates the technology for this new kind of power shift where we've given up trusting the banks. We've given up trusting who were supposed to be the fiduciaries, and we can take control back ourselves. Even identity will go on the blockchain, so we can share it with Facebook and Google on the terms that we accept. So this is a technological and a financial and a cultural revolution all at the same time.
So it's interesting that you brought up people are losing trust with banks, especially after we saw happen in 2020 and 2021, where the Federal Reserve Bank printed trillions and trillions of dollars to stimulate the economy. I mean, I think that's another argument for why people are moving towards cryptocurrency. But what happens to institutions like the Federal Reserve Bank if people start to adopt cryptocurrency more? Because I have a feeling, you can correct me if I'm wrong, that they're not going to like it.
Correct. So what the Federal Reserve are doing is they're looking at the macro backdrop, which is the most indebted global economy in all of history, 400% of GDP in debt, of which the US is by far the largest. So you've got this situation where the world is in debt, the population is aging, you can't generate growth, and jobs are being competed for by robots, AI, globalization. So you've got this structurally very difficult world. How do you service the debt? And the answer has been to print more money. Now, printing money lowers the value of fiat currency. All the central banks are doing it at the same time. So it's not just the dollar or the yen, it's all of them. So that whole printing of money means if you make something overly abundant, it becomes worthless. Now, it's not saying fiat currency is worthless yet, but basically the central banks are increasing their balance sheet by about 13% a year since 2008. That means we're all getting poorer because wages don't go up, but assets do. And assets are future savings, a future expenditure. So you stick it into, let's say, a second property as an investment, and then you'll sell it in due course because you want to realize the money to be able to spend. That's what all assets are. They're deferred consumption. But it means that we can buy less of those because they keep going up. They're going up because the value of the dollar is dropping, the denominator, not because the price is rising in terms driven necessarily entirely by demand. So we're all getting poorer, and this helps that. The central banks don't want it because they don't want the debt bubble to burst. So they want you to keep in the system, devalue your savings, devalue your working salaries to try and keep this system alive to protect the baby boomers who've basically got most of the debt and most of the issue.
So do you think that's ever possible though? I mean, if just thinking about that logistically, the United States is drowning in debt. And if people move away from the dollar, how would they be able to survive?
Well, they don't have to move away from the dollar. You just need what I call a life raft. We all need somewhere to put our savings that doesn't get affected by the central banks. And Bitcoin the greatest example, there's 21 million of them. There's a known supply. It can never be printed. You can't increase the supply. It becomes scarcer over time. So that becomes something very interesting because it more than offsets the printing of the Fed balance sheet. In fact, it's about the only asset, aside from some technology stocks, that's done this. So don't think of it in terms of systemic catastrophe. Think of it as individuals. We've got the choice. So we won't change entirely out. Some people entirely live in the crypto world because you can earn yields and you can borrow and you can invest. But maybe for many of us, we put some of our savings there and allow our savings to grow in that space in a different way and still operate in the normal world. So I don't think it's a competition at this stage. 20 years' time, let's talk again, because these worlds are meeting. And if this proves to be a superior way, it's difficult. And the central banks are trying to fight this head on, not fight it, but kind of dovetail in with it by building their own central bank digital currencies, which are still fiat-based, so they still get devalued, but they have some of the attributes of this new technology, meaning instant transferability and accountability and that kind of stuff.
An interesting thing that I heard you talk about before is the issue of risk. And with the Federal Reserve Bank printing so much money, essentially stimulating our way out of a recession, a crash, trying to eliminate risk. And that being a reason people are moving to cryptocurrency, because we're seeing what's happening with the dollar, like you just talked about. We're seeing the dollar get devalued. I mean, is that why people are moving to cryptocurrency? Because they're worried about the value of the dollar, or do they just want to say, screw you to the government and to central banks?
I think it's all of the above. But if you think of it, again, I'm a macro guy at heart, and I look at bond yields. People used to have bonds. We don't now because there's no yield. So yes, the system owns them, but as individuals, they're not interesting to us. So that's taken the bond market, the biggest, largest source of investment on earth, has just been taken out of the equation. It's just not relevant to us. You might as well own cash. And the Fed decided, well, we can't allow, because all the companies are so in debt, we can't allow the credit markets to blow up because that would be a house of cards. So they started buying credit. So credit now doesn't react to the business cycle. So that's taken that out. And then we've got the currency markets. So now we're not talking about the debasement of fiat currency overall. We're talking about the dollar versus the yen versus the euro. That's been flat for 6 years now because the governments don't want it to move, because if the dollar moves too far, it blows up the world again. So what we've got is very few avenues to actually make money. Now, real estate, sure, but it's expensive for most people. And also, banks don't want to lend necessarily unless you're rich already. So what avenue have you got left? You've got the equity market, all-time record high valuations. Okay, money's going to keep going in and it'll get more crazy in valuations. But is that the best bet? Or is it the market that has a 2 trillion valuation that could go to 100 trillion and is the future of the entire financial system and global business model? It kind of makes sense for people to start reallocating assets.
I mean, cryptocurrency, is it an investment or is it money? Because, you know, when I keep cash or I buy gold, I don't look at that as an investment. I look at that as money that I'm holding or saving. But it sounds like you're looking at cryptocurrency as an investment.
I'm looking at it as both. Some people philosophically want to use it as money. That's okay. I'm pretty happy using the US dollar for transactions. I don't have any savings in a bank account right now. I mean, I'm 100% allocated to crypto, which is an aggressive risk strategy because this is a 70% volatility asset. So it's extremely volatile, but it's the right point in the risk cycle for me to take that risk. But generally speaking, some people want to get out of this system entirely, and I get that and I respect that. Others just want to use it to offset what the central banks are doing and making sure that their savings grow still while operating within the current system, because it's bloody hard to buy a house with cryptocurrency right now.
You know, I've heard mortgage companies they're thinking about adopting cryptocurrency. I was reading an article about that the other day. But how do you, okay, so if you said 100% of your assets or your savings are in crypto, how do you buy things then? Because I can't go to Amazon and buy anything with my Ethereum.
Well, the secret is why I can take that risk is I have income. The really important thing about risk is to set up yourself to take risk. So you either have nothing, then take as much risk as you want, or you build up an asset base, you own your house, You have an income, so you can cover your costs of living, and then your excess savings, you can then risk if you want to, because you can always make it back over time via your investments, and you're not going to lose your house. So setting yourself up for risk taking takes time. It comes later in life, but you suddenly occasionally get an opportunity like this. Now, this is the biggest I've ever seen, but it does come across from time to time where you can swing the bat and take the big bet.
I like how you said that, where there's a time and place for risk, where, if you're trying to build yourself, you're saying maybe don't take 100% of your money and put it all into cryptocurrency. Build yourself first.
Yeah, but you saw the opposite too. People who had nothing to lose, which was the millennials and Gen Z in March to June 2020, well, they had nothing to lose and they got given a free check. So they're like, sod it. Let's go and buy some options. And they learned about risk, and a bunch of them made a ton of money from it, and it paid off. But had they lost that $1,200, it was free money anyway. So that was intelligent risk taking, even though it looked like it was the crazy Wild West. It was actually pretty smart.
With all the talks now of the stock market being in a bubble, the real estate market potentially being in a bubble, with all the cheap money, all the cheap debt out there, do you think that could affect cryptocurrency and cause a potential cryptocurrency crash?
Cryptocurrencies are cyclical assets, as many assets are. Most assets are driven by the business cycle. Cryptocurrency less so. It's driven by this cycle, driven by Bitcoin itself, bizarrely called the halving cycle, when supply gets reduced every 4 years. And tends to then lead to a speculative bubble, and then we tend to get a bear market. It also usually coincides with when the central banks have finally stabilized an economy after a bad period. So we saw central bank printing in kind of 2015, 16, 17. That was the period where Bitcoin did well last time. Then the world's economy recovered, Bitcoin did less well. So it tends to be the slight inverse of those central banks. So when the business cycle is looking good, you might want to own more equities than you own crypto. But when you're in this early stage where the central bank's probably going to print more money, you'll want to own some of this. So it has its own cycle. It has huge downside, but the upside is even bigger. So in financial market terms, we refer to as the risk reward. So the average annual return of Bitcoin is about 120% a year. So it's 120% a year in price appreciation. And I think the worst down year in the history of Bitcoin was 45%. So almost every day you enter the Bitcoin market, it's a 2-for-1 risk reward. Now that really works over a longer period of time, a few years. But if you look at a chart of Bitcoin, it always does this. It's an exponential chart. So you need to put it on a log scale. And what happens, magic happens when you put it onto a log scale. Exponential assets on a log scale makes sense. It trades in this beautiful range on this upward trajectory. Now that range on a normal chart looks massive, like down 70, up 700%. But when you're on a log chart, it's like, oh, I get it now. This is just a more volatile asset. But the rewards over time are amazing.
Interesting. And, diving deep a little bit into cryptocurrencies themselves, because there's a whole bunch of different cryptocurrencies out there. Bitcoin, Ethereum. What is the difference between, say, Bitcoin and Ethereum, and why are there so many different currencies?
Well, firstly, Bitcoin was the big daddy. It's the OG of the space. And it was based on the context of money, a store of value, introducing the idea of blockchain, this very limited supply, this hugely distributed network that's incredibly safe. So it has properties that almost no other blockchain has. And its adoption means that its value is now accepted amongst millions and millions of people. So that's Bitcoin. But Bitcoin, because it's so secure and so amazingly built, makes it less fast for transactions. So then back in about 2015, Ethereum came out. And Ethereum solved two things. One, making it faster. And two, adding something called smart contracts. Smart contracts allow you to program the bit of the blockchain to say a specific thing. If this, then what? Those kind of things. Which meant that suddenly you could program this blockchain and create all sorts of things. And that kind of grew for a while. And then we all had the crypto winter, the bear market, in 2018 and 19. And then suddenly out of the gate exploded DeFi. NFTs, social tokens, all of these things being built on smart contracts on Ethereum. And the network effect on Ethereum was gigantic because it was growing really fast. So think of Ethereum more as a software platform for the Internet of Value. And think of Bitcoin as the pristine collateral, the base layer of it all. Then you've got other things like Solana or Cardano, or there's a whole bunch of these out there, Terra, which are layer one solutions. They try and do the job of Bitcoin and Ethereum, but in different ways. There's always a trade-off. The trade-off is security of the network by the number of people who secure the network. So Ethereum has less and it's done in a different way. And then Solana and others have less, but it's super fast. So they change how the blockchain works to increase speed. So maybe Solana is really useful for financial transactions. So there's a lot of this going on in the space where people are solving different needs by different groups. Ethereum is so popular that the costs, called the gas fees, of using are expensive. So again, some of these others have solved that. But most people want to build on Ethereum because that's where the network is. That's where all the developers are. That's where all the mindset is. But it shifts around. Then there's other ones like DeFi, decentralized finance protocols, which give you yield for your money. And that's a whole different set of protocols. And then there's ones for NFTs and social tokens. They're all different as well. So they all solve different needs. And what if you think of it, think of this hive mind of the smartest people in the world of finance, technology, and mathematics all getting together and saying, you know what, we're all going to solve the world's problems. And how we're going to do it is we're going to break up into small groups, expert groups, and solve little bits at a time, all at the same time. That's why it's so fast. We've never seen anything like this before, with the amount of brain power going into this to break down small bits of the financial system, the business model, whether it's IP rights, whether it's how to empower communities, or whether it's how artists can monetize their money. So many things. People are looking at that one specific use case, getting a group of 20 people together, the smartest people they can find, and say, right, let's go, raise some capital and do it. It's incredible.
So how does somebody now who is watching this thinking, I want to get involved in cryptocurrency, how do they find a good currency to buy or invest in? I mean, like Elon Musk was a big talker of Dogecoin, and just more recently, Shiba Inu, which rallied, hundreds of percent so fast. How do you decide what's the good way to go?
Simply, you go to how financial market participants look at risk. And this is a really good lesson for people, is when you're learning about something, allocate to the least risky asset to start with. Open a wallet, get some Bitcoin, get some Ethereum, get those two assets, understand them, understand how it transfers, how you store it. And by doing that, you'll suddenly start picking up on Twitter or Instagram or anywhere else. What are people talking about here? And then you'll start getting exposure to all these coins. And you're like, I can't get my head around this. But let's say you want to go out on that risk curve and take a little more risk. Well, then the best way, what I did was I don't know which one of these is going to succeed and which is going to fail. So I'm going to take some of the middle to upper tier of these and just make an equally weighted basket. So I bought 15 and did equally weighted and spread it across the different types of sectors and said, well, now I'm going to watch it because now I've got a bit of skin in the game. And if the whole space goes up, I'll do well. But I'll notice when some of these start making breakouts, and that's usually to do with the network growing fast, i.e. more people are building on it, investing in it. Doge was an interesting case because the network purely came from retail investors. There was no use case. But then Mark Cuban looked at that and said, well, if there's a massive network of people who own this form of money, well, why not sell Dallas Mavs tickets and merch and take Doge? Because it's a whole new group. So now you've created an application. Next person was Elon Musk. He's like, well, here's a network. It's growing massively. So maybe I can use this. And I still think that he will end up using Doge in some way for, let's say, streaming payments from Tesla, because he can. So we don't know which ones are going to succeed. So you can buy a basket of these things, and then you'll get to know what communities you like, what projects you're interested in. What is really interesting, like I'm not wildly interested in DeFi. I'm not bothered about yield. I want to make capital gains. I've got an income. I want to make some capital gains and I want to see technology change the world. So I'm actually more interested in some of the other things. So you'll over time start reallocating, but that's the way to do it. Don't go into the latest meme coin that's gone up 1,000%. Start at the beginning, Bitcoin and Ethereum, get a feel for the space, understand what it means when it goes up 30% in 3 days and then down 30% in 3 days. Get comfortable with it, then start allocating it outside.
Can you expand on what you meant by there is no use case for Dogecoin? Because I think, we understand what it means with the network effect. If I'm a big fan of Ethereum and I tell everybody, hey, use Ethereum, now I'm a natural affiliate for Ethereum because I'm telling my audience, my friends to use Ethereum. And if they buy Ethereum, then there's more buyers for Ethereum, which makes them more valuable. But what makes...
So that's one side of a network, right? So you've now got users who do nothing but put money into the network and spread the network to get more people in it. What makes a network really take off is when there are applications. So if you think of Ethereum, we had the investors, then we had stuff like decentralized finance, hundreds of protocols, businesses all being built. Then there's NFTs all being built. So now you've got use cases, projects, people are using it for transfer payments, all sorts of things. So now you've got these users who are the investors in the network, who are securing the network, and now you've got people building other applications on the network. And so if you think of Facebook, if Facebook was just you and I being able to chat on Instagram or whatever it is, valuable. What's really valuable is when all of the brands and advertising businesses built on top, or you build communities on top like we've all built on YouTube, right? You're basically helping the YouTube network. Now, in the case of YouTube, Google gets all the money. You get some of the advertising revenue. But in the case of crypto, you all participate, including these businesses have built on it.
So what makes that possible with something like Ethereum and not Dogecoin? Is that the blockchain behind it?
It's the vibrancy of the developer community and the blockchain behind it. And the more brains that accumulate in one place, the more it becomes like a supermassive black hole and accumulates more people. So Doge, the people who built Doge did it as a joke. But it was a decent enough blockchain, but not great. And it wasn't great because it wasn't as robust and it wasn't as decentralized and a number of things. And the developers stopped working on it. So it never got improved, never changed. Now, Bitcoin doesn't need to change because it's kind of, yes, there's been a couple of changes over time, but generally speaking, it's very static. Ethereum's much more dynamic, but Doge was nothing. It was abandoned. So there were no developers working on it. Now, the original team have got together again because I think Elon Musk is backing them to start building on it again, to start changing the attributes of that. So, okay, this is starting to get interesting. I own some Doge for this reason. I saw that network of people and I saw that it had no real use case. It's still speculation. Then I saw people accepting it for payments and realizing that this is a community of Dogecoin owners who kind of know it's a joke, but also know it's serious. And then you start to see, okay, they're going to start building stuff on top. It's interesting to own now.
That's interesting. Now, one concern that I have about cryptocurrency is it's entirely on the internet. It's very digitalized, or it is completely digitalized. And if you saw what happened, we talked about this with Facebook recently. Facebook, Instagram, WhatsApp were shut down for half the day. What happens if the internet gets shut down, or if it's a cyber attack on cryptocurrency and now you can't access your money?
So the nature of the distributed network, the nodes in cryptocurrencies, means that they're all over the world. You'd have to shut the entire world's internet down. There is no single point of attack. It's not Facebook. Facebook is one company. So there is no single point of attack. So it makes it extremely hard to stop. Thermonuclear war could do that, but your crypto still doesn't disappear because the blockchain will always exist. And as long as you've got it on your cold wallet stored, it can't be taken away. So it is kind of nuclear proof. Just because the internet goes down for a bit and you can't make a payment, well, figure it out with barter. Because if the internet's gone down, none of the banking system works around the world. You've got no way of making a payment. So it's simply not a crypto problem. It's a world banking problem. So all cash payments, because 90% of every payment on Earth, or 99% of every payment on Earth, is done electronically. So that's kind of not an argument for crypto. But what's amazing with crypto is there's no single point of attack. So there's no cyber hack that can hack the Bitcoin blockchain. It's impossible to do, or as impossible as it possibly could be.
Are you worried about what China's doing, though, and putting on regulations on cryptocurrency? And are you worried that that could potentially happen in the United States if the central banks and the Federal Reserve Bank say people are getting too much power with cryptocurrency and then they put on more regulations?
I think it will get regulated. And just because Apple is a security that is regulated doesn't make it less attractive. And many people own Apple. So it doesn't have to be the Wild West. There can be an element of regulation. Last night, I spoke to the chief fintech officer for the Monetary Authority of Singapore, and he explained their approach to regulation, which is, I think, what everybody's going to adopt in the end, which is we can't just keep using these 1934 securities laws and tell you what you can and cannot buy. What we're going to have to do is give you a warning to say, this is risky. And are you sure you want to do this? We are not comfortable with this because you could lose all of your money. That is a much better approach, and giving people the freedom to do what they want. Regulators are still struggling with this. Now, the issue is, it's currently a $2 trillion market cap. My fear is by the time we get to like March of next year, this is going to be a $10 trillion market cap. Regulators can't go back and fine all these businesses, tell you it's illegal. What, a $10 trillion industry? So there's going to be a grand compromise. Regulation is going to be part of the space, but they're not going to be able to force you out of it. China is a autocratic regime, and they have forced people out. But guess what? It still goes because it's on the internet. It's impossible to stop. You just need to circumvent it. So Chinese people just go abroad. So they just have it in Singapore, and they hold it in Singapore. They only access it via Singapore. They go back to China. There's nothing they can do. The Chinese are trying to introduce their own central bank digital currency, and what they're actually trying to do is stamp out capital flight out of the country and excess speculation on leverage, which China's got a historical problem with. So it's not that they're anti-crypto, it's they're currently anti how it's being operated within the system.
Do you think the Federal Reserve Bank would ever try to create their own cryptocurrency?
Yes, for sure. Be called a central bank digital currency. It'll most likely run on one of the private stablecoin rails like Circle or Paxos or one of these. And it will not be a full cryptocurrency with a limited supply because that's not the central bank's job. The central bank's job is to vary the supply of money to help drive the economy. So it'll just be probably a blockchain version of fiat currency of the US dollar, which means that I can send you money instantaneously. We get around all of that. We've got proof of the money and its transfer and where it's gone and the storage and all of these things. And they get to build in KYC and AML into all of the network. And so that helps velocity of money. It destroys middlemen. It makes the business of money much more frictionless. But it's not a cryptocurrency in its own right because that's kind of the opposite of what central banks do.
On more of just kind of like a world level, what would happen then if the Fed starts losing their power or control over money? Like, what does that mean for society?
What it means for society is it depends how they lose control. If they lose control quickly, it means you can see a hyperinflation, i.e. that's when the value of your currency collapses because there's no faith in the currency. I think that's unlikely. I think the most likely outcome is just that more people opt out of the financial system into this new parallel financial system. So that removes the power of the banks and it changes the landscape. So obviously the Federal Reserve and the SEC want to regulate as much of this as possible, but it becomes harder to do because it's so distributed. Nobody owns these things. Many of them, they just exist. And so who do you prosecute? What do you do? So they're going to have to accept that money is going to be out of the system. And in my viewpoint, over time, it creates a competition between the central banks and these digital currencies to not debase your currency. Because if you do, we now have an ability to vote that we don't like it. We did before with gold, and gold has always existed. as a way out of the financial system. And you've obviously got Indian heritage, as do I, and Indians understand this completely at core. And it's for the very same thing: is the government can do what they want, but if I physically own my gold, it will protect its purchasing power over time. Proven. This is no different.
Interesting. So somebody here that's going to think, all right, I need to take some of my cash and go into cryptocurrency. Do they just go in and buy, or should they wait for a dip or a dollar cost average? What do you think is the best way for somebody to start buying cryptocurrency?
So psychologically, well, it's been sideways correcting, actually, pretty much. Ethereum and Bitcoin reached their peak between March and May this year. So that means it's been correcting and storing up power for potentially the next move higher. So it's not a bad time to just put the money in. If you decide you've got a couple of grand you want to put in, now's a good enough time as any. Then dollar cost average. So then start averaging in a bit of your paycheck and put it in to crypto. So then when it does sell off, you're buying. So you'll keep adding into the weakness and into the strength. And over time, that strategy will work well if you're looking at a long-term point of view. I think it's probably a bit late to wait for a large correction because we just had one, which was a 50% correction over the early summer. So that was the time to really deploy into a correction. So I don't think you've got that opportunity. Sure, could we fall 20% and you could cheekily add some more? Fine. Use your dollar cost averaging for that. But I'd be of the opinion that it's been correcting for so long and traded sideways for so long. It's a pretty good time.
What about DeFi? Can you talk about what DeFi is and how people are making money off of that? Because the whole concept is very new.
So right now, if you have a bit of savings, you stick it in the bank, you earn a big fat 0 in interest. DeFi replicates how the banking system creates interest, which is people want to borrow stuff from you, lend stuff, and there's an interest rate for that. And there's another thing called staking, which is you put your coins to secure the network and you get paid a yield by the network for doing so, some of the rewards of the network. And they generate yield. So the yields in the DeFi space, in the crypto space, are somewhere between, if you're just lending out straight Bitcoin, it's about 3%. But if you're doing other things like staking or some of these yield plays, which have a little more risk, you're getting 8, 10, 15, 20% yields. So suddenly you get interest on your savings. Now, the safest way of doing it, in my view, is stable coins because they're pegged to the US dollar. So there's a stable coin like Paxos, which I think is USD. That is a very secure underlying stable coin run by world-class people with regulatory approval. And you can lend it out via an exchange or others for about 8%. So you've got US dollar, no price risk. You don't care whether crypto goes up or down. And you're getting 8% on your income. That dawned on me recently because a mate of mine took off some of his Bitcoin bet. And he suddenly sent me a WhatsApp saying, oh my God, I've just realized I'm not going back to the financial system. Now, again, he's a lucky guy. He's got plenty of savings. He's got some income. He owns his own house. But he took some money off, some profits. And then he put it in his stable coin. And he's like, I'm now getting 8% yield on my profits. He said, why should I go back to a normal bank? And I can transfer this instantaneously anywhere around the world. So DeFi is that. Now, there's a lot of different protocols and they're all complicated and it's not an easy world to understand. There are relatively simple ways that you can do it with exchanges like Coinbase and Kraken and Binance and stuff like that. The DeFi protocols, you can also just own the tokens. So you find something like Aave or Compound and you buy the token. And what you're saying there is you're going to take a bet that the network's going to grow because people all want to use this new DeFi technology to generate yield because the whole insurance industry, the pensions industry is all going to move into this space because the yields are better. So those tokens will go up. So that's another way of playing. It's just own the token. So if you don't want the yield, but you believe in this decentralized non-bank finance that's taking over the world, buy the tokens. So there's different ways of playing the space.
So in the first one that you just talked about, you buy a stable coin and you're essentially lending it out. Is that what you're doing?
Yeah, you're essentially lending it out for people like market makers and other users. And there's a yield for that.
And they're paying 8% or so.
Correct.
Why are they doing that instead of going to the bank and borrowing at 3.5% or 4%?
Because they're in the crypto markets and nobody will lend them money.
So because the banks are not willing to lend them cash, US dollars at 4%, they have to go to the crypto market, borrow these stable coins, and they're willing to pay you 8% or more on your coins.
And here's another example. So in Asia, different world. So in Asia, a Malaysian exporter exporting goods textiles to China. So what they need to do is, firstly, they need to source the cotton. So they buy that from India. They then manufacture this, sell it to China, and then the Chinese will make payment. Now here you've got a problem, is you've got Malaysian ringgit, the Chinese yuan. If you try and do that currency transaction, it's going to cost you about 10%. You're paying middlemen. Then the central bank requires all sorts of other regulation because they've got capital controls. So basically, it's about a 15% cost. Now, in a textile business, the margins aren't that high. So if you can use a stable coin instead, send instant payment or get paid by the Chinese instantaneously, and with the currency transaction included, or you do it in US dollars and it clears in seconds, you have none of these problems. So they're saving 15%. So if it costs them 8% to borrow the stable coin, they'll do it all day because they're still making another 8% extra on top. So there's different reasons why people want access. The world is also not able to access dollars very easily. So, if you're in India, for you to access dollars is not easy. So you're restricted in the number of dollars you can get access to. Well, stablecoins get around a lot of that. It makes it easy for me to send money to family in India instantaneously or them to get money out. Now, obviously, the Reserve Bank of India wants to regulate that to make sure that the capital doesn't flow out of the country too fast. But stablecoins are a way around it for a lot of people, getting away around the slowness and the complications of global payment rails.
That's interesting because I think one of the issues people have is how long do I have to wait to get a return on my investment? And with this, now you can get paid while you wait.
Yeah, exactly. Now, and with Ethereum, let's say, they're moving to something called proof of stake, ETH 2.0. So proof of work is when you get, like Bitcoin, tons of computers solving complex algorithms to then say they solve the equation, they will get rewarded in Bitcoin. And that is how you make the network robust. Between that and the nodes on the network, who are the people who are kind of recording the blockchain. With proof of work, that's slow and expensive. With proof of stake, what you do is I own some ETH, I pledge it to the network, and that secures the network, and in exchange, I get paid a yield. So now I'm sitting on my Ethereum, what I would have done anyway, and I get paid a yield to do that. If you own gold, you get paid 0 yield. So, okay, this is like gold with a yield. Okay, that's interesting too. I mean, every time you look at this from every angle, all of this space, it becomes kind of the vastly superior asset to anything you've seen. Because it's like gold, owning gold with a yield, but it has the return profile of a successful startup. And it's a new disruptive business model that's eating the world, and the world's smartest people are involved in it, and it's a network of money. I mean, what is there not to love?
I mean, is that kind of like what saving your money in the bank used to be like, or is supposed to be like, where you have cash and you put it in the bank and you get an actual return on your money? It's kind of like that.
So when my dad retired back in 2000, I got him to stick all of his savings in, he lived in Spain, so in European government bonds. 5% yield. He knew what he had. Problem is they ran out after 10 years, they mature. Where were they then? 2%. What that means is his income had more than halved the next time around. And then the next time, if we were alive today, it would have been zero. In fact, negative. So,
Wow.
so all of his income has been entirely wiped out. So he now has to eat his savings. So that is what the change in the system has been. And he's anchored on the past of the 80s, where he was getting 10% interest. That was the calculation. You put your money in the bank, get 10% interest. I never saw that,
Yeah.
because I was the 90s and 2000s, and interest rates went from kind of 6% in my lifetime to negative. So yeah, that's what the world used to be like, is you put it in a bank because they use your money. They use your money and they should pay you for it, but they don't. And so what happened in Europe, and it happened in Cyprus first, is the bank went bust. And they took all of the savers' money, anybody with over 100,000 euros. So therefore, you're putting it in a bank, accepting the risk of the bank going bust, which historically was not the case, and then not paying you for it. That's the definition of insanity. I'd rather take the risk of something going wrong in a stable coin or a DeFi protocol and getting paid for the risk than not at all.
Yeah, and I think it goes back into the Federal Reserve Bank there, because then you got the FDIC coming in and insuring your deposits. But what does that really mean? Because if the bank goes under and the Fed has to print more money to cover your deposits, well, then that devalues the value of each dollar that you had saved in the bank at the first place.
Correct. Again, another great use case of why crypto is so different. It's complete antidote to the mess we've got ourselves into.
The last thing I want to talk about are NFTs, because this has been very popular. I think young people kind of understand what NFTs are because they've been kind of growing up with video games and buying things in video games. What are NFTs? How do they work? And how can someone make money on them?
So if you remember, we talked about Ethereum and the smart contract. An NFT is a smart contract that holds a digital asset currently. It'll go to physical assets as well, but mainly digital asset. Let's say a piece of art. That was the first use case that really blew up. So as everybody knows from skins in games and everything else, these things are transferable. The problem is, in gaming world, you can't transfer it from one game to the other because they weren't on a blockchain. So they weren't fungible elsewhere. But this, you've got something that is transferable to anybody, and it's a piece of digital property. The world is learning very fast that digital property has value. So imagine the skins that you have in Fortnite. Well, I've just been seeing Dolce & Gabbana and Balenciaga developing 4K, skins within the Unreal Engine for Epic Games.
Oh my God.
Unbelievable. And I could then wear that in the metaverse.
Oh my God.
What am I going to pay for that? Probably a lot of money, right? Because it's rare as hell, and I own the original. So,
oh wow,
yeah. So, and then there's all of these communities that are building up, like Bored Ape Yacht Club and CryptoPunks, where you're kind of self-identifying yourself with the community by owning one of these tokens, of which there's a limited supply, and then they're kind of saying, well, we've now got you all together. What should we do with the community? So it's like building a business from the ground up with no particular plan. Really interesting social experiment going on. So there's all sorts of things, but how the hell do you navigate this? And the answer is, I don't know. Because it is hard, because there's so much rubbish out there. The things that are clearly valuable are clearly too expensive. So a CryptoPunk minimum price, the floor price is like $600,000. Some of the great digital art, people like Beeple are selling for millions. So it's already kind of happened super fast. So how do you play that? The easiest way, own Ethereum, because it's all on Ethereum, and a little bit's on Solana now. And then if you find a community you like, and you engage with them on Discord, and you find it good, give it a go. But don't bet the ranch on this, because a lot of this, 95% of the space is going to go to zero, and we just don't know what.
Yeah, the thing that I found interesting, personally, I don't buy art. I mean, unless I need something for my house, or I don't go out and buy expensive pieces of art just because I don't do that. But on the internet, it's a little bit different because, let's just say we're talking about an image. I can go to Google, find the image, right click it, and save the image on my desktop. How is that different than now you who might have paid, let's just say, $100,000 for an NFT, that actual image? How do you tell the difference?
So start the simple way. I can go to the Louvre and take a picture of the Mona Lisa. What does that do to the Mona Lisa? Does it make the value go up or down? It actually goes up because it shows that people have a love of that painting, right? The more people that see that painting, the more that they value it, and the more that its value is cemented. Bizarre, right? It should be the opposite. People should say, well, everyone can have the Mona Lisa, it should be worthless. Okay, then you'll say to you, no, but Raoul, it's paint. Right, well, we can copy the Mona Lisa. So why is that not worth the same? Well, really good forgeries can be worth tens of millions by mistake, but they're not worth the same as a proven original. Why? Because it has the signature. Authenticity is what humans value more than anything else. Right? The authentic thing is scarce. So on my wall here in my house in Grand Cayman, I have rock and roll photographs. Photograph? Sure, that's worthless. Anybody can have a photograph. Right click. No, but mine are signed by Mick Rock, one of the most famous photographers of all time in the space, and that are limited edition prints. So that makes them worth a few $1,000s. If I'd got the negative from Mick Rock as well, it's probably worth $50,000. So layers of authenticity are what humans absolutely love. So the right click save to the desktop does nothing but build the value of the actual authentic one. Because if you own it, you've got the bragging rights and you can prove it. You can prove it to anybody. You can prove it in a court of law, in a divorce case. You can prove it anywhere you are in the world instantaneously that you own this, and this is what it's worth. That's powerful.
And so you're saying that Ethereum now, a lot of the NFTs are built off of the blockchain on Ethereum. And so one of the ways to kind of invest in NFTs, not necessarily own an NFT, is to own Ethereum.
So if you think of Ethereum as a relatively low supply cryptocurrency, and each one of these use cases is pulling crypto out of the market. The more of these things get built, the scarcer Ethereum is. So currently, because of the staking I talked about, because of the explosion of NFTs, because they're now locked onto an Ethereum on the blockchain, and because of the explosion of DeFi and other things that are going on, there's only 11% of all available Ethereum available to purchase. 11%. So that's basically $30 billion. It's a $300 billion protocol or whatever it is today. A $300 billion protocol. So it's $30 billion. So Elon Musk could go in, take all the Ethereum out of the market. We know what happens in supply and demand terms. But what's going on is exponential demand from NFTs, DeFi, everybody's coming on, new investors, and the supply keeps shrinking every day. It only means price explosion, an exponential price explosion. That's the most likely outcome. Now, I'm not giving investment advice, but I'm giving what my view is. And my view is, and where my money is that this ends up with dramatic upside.
Interesting. Now, the last thing that I want to ask you regarding that is actually a differing viewpoint, because Ethereum obviously is very interesting. They have the blockchain technology, the NFTs, like you were just talking about. But what about all the debt that's in cryptocurrency? Like Michael Burry has come out and said very openly that the mother of all crashes is coming. Cryptocurrency is going to crash. And if you don't understand the amount of leverage that's in cryptocurrency, then you don't understand cryptocurrency at all.
And he doesn't understand how leverage works in crypto versus traditional markets. So right now, the most leverage people have is their house. If your house starts falling in price below your mortgage, you have what's known as negative equity. And it becomes harder to pay back your mortgage. What do? Well, at some point, you might try and sell your house and you can't sell it, and you're then losing more money and you're locking in losses. Or let's say you're trading a futures contract which is how the financial market gives leverage to people. Well, you have something called a margin call. So you put some money up, but then you lose that money, and they kind of wire you for a margin call that you have to then settle the next day. Now, if the market crashes, you're going to lose more than you put in, more than you could afford. You can entirely wipe yourself out. And that happens time and time and time again in the financial system. Why cryptocurrencies are different is they're 100% collateralized, which means that what you get in your leverage is an instant liquidation when you've got to the point that that your collateral is worth zero. So it basically automatically takes you out of unlimited losses. So you can only lose what you put in. So that's really different. So yes, there's a lot of speculative leverage in, particularly in Asia, but it can be wiped out in 2 days, 3 days, all out. Because everyone takes their loss, they're all forced liquidations, the price collapses, and that's it. No systemic risk. Now, 10 years' time, when there's more leverage built in by other players, that may change. Right now, that leverage is instantaneous liquidation risk, big price spike, done. Well, if you think of what happened to Lehman Brothers and all of that, that was an ongoing nightmare of trying to get your assets back. Who owes what to whom? We have no idea. That never happens in crypto. Everybody knows who owns what to whom instantaneously. That's the magic here.
What if people are borrowing money externally? They're going out, let's just say refinancing their home, taking out credit card debt, using that money to go out and buy Ethereum and Bitcoin. Wouldn't that make the bubble bigger?
Yes, but they could be doing that for stocks and anything else. Now, I imagine that a $300 trillion, $150 trillion market cap of equities has more of a problem with that than there is with 150 million people in crypto. So, there's billions who invest in equities. So, no, that's just a humans being stupid with risk taking, and that will apply to all assets.
Great. Well, that was a wonderful interview.
It's not a crypto thing.
I appreciate your time, Raoul. Sorry for cutting off on the last sentence, but I don't want to take too much of your time. That was an amazing interview, very insightful about cryptocurrency. I'm going to put the link to realvision.com/revolution so people can learn more about cryptocurrency and Real Vision. Are there any last words or messages you'd like to leave?
No, I mean, that Real Vision crypto, I built on purpose for free, because this is, if you can't tell from this interview, this is the single biggest opportunity any of us are ever going to be given. It's the most exciting space we've ever seen. And so I wanted to make sure the resources available for everybody to learn about all of the questions you were asking. And they're all on Real Vision Crypto, all the interviews with all of the best people. So just go to realvision.com/crypto/revolution and just sign up. Cost your email, and what you'll get in exchange is an immense education in this exciting new world.
Absolutely. I mean, if you're watching this video and you're interested in cryptocurrency, you need to go check that out, and I'll put it in the link in the description. Thank you so much, Raoul. I really appreciate your time.
Not at all. Really enjoyed it. Thanks so much.
Bye-bye.
Bye-bye.
Thank you for watching. If you enjoyed this video, here's a video on things you need to know if you want to become wealthy that I think and love. And while you're at it, download our free guide on investing your money in the stock market. And as always, keep hustling. Do you think that cryptocurrency, Bitcoin, is the future? Is that a way for someone to now build wealth quickly?
Well, it is, but it's highly valued now. I have a 3% allocation in Bitcoin in my own portfolio. I have 5% weighting